Welcome to Alaka, a podcast about the relationships shaping systems, capital, and the climate transition. This special playlist is developed in partnership with Change Now. We welcome some of the fund managers who presented during Funds for Change. Since they only had but a few minutes on stage to explain the unique angles, the sophistication of their approach, the urgent needs they want to address, we decided to offer them more time and broadcast their ideas to a wider audience. Today, I'm joined by Sandrine Henton, founder and managing director of EG Capital, a private credit investment platform focused on climate adaptation across Africa. Her work sits at the intersection of climate finance, resilience, and capital allocation, helping shape new approaches to investing and adaptation across emerging markets. So why is Sandrine with us today? To be serious about planetary boundaries, we collectively need to be serious about how we channel massive amounts of private capital towards Africa, because the scales are more than uneven at this point, and our collective futures depend on it. To do that, how about we started assessing risk from a clean state with actual data? Because finance and investments are all about data, right? So let's see what Sandrine can tell us about it. Sandrine, welcome. I'm so happy to see you again.
So lovely to see you, Imen, as well. Thank you.
I feel like I'm saying this to every single guest on this special season of Alaka with the Change Now. 2.5 months went by. It's a very slow and also hectic period, and I nearly feel some nostalgia, for something that happened not so long ago. I don't know how you feel about that.
Nostalgia for sure, but we still carry the positive vibe. So it's true that the time flies a little bit too quickly. Absolutely.
So Sandrine, thank you for making the time in your intense schedule. And as any investment manager knows, but also as any founder, and we were discussing just a minute ago about the parallels between emerging manager stamina and resourcefulness and determination and grit, and the one that we find in founders as well. So thank you for making the time, because I know it's intense at the moment. And to kick off this discussion, would you mind telling us a few words about your fund, what it's all about, and how unique it is, especially in this perspective of, contributing to coming back to planetary boundaries?
No, lovely. Thank you. And indeed, the EG Economic Empowerment Fund is a $100 million private debt fund investing in climate adaptation, economic resilience across East Africa and the SADC region. We provide flexible mezzanine financing to growth stage SMEs in sectors such as food security, health resilience, emergency services, and human capital. And what makes us different is the blended finance structure, which combines guarantees, junior capital, liquidity facility to de-risk investment in frontier markets, whilst at the same time unlocking capital for underserved businesses.
Let me interrupt just here. Okay. This is one of the elements that particularly struck me when I introduced you on stage at Funds for Change, which was the level of sophistication, financial sophistication and financial engineering that you put in place to design a vehicle, a private debt vehicle of 100 million. Like you would expect that from a 1 billion or 10 billion type of vehicle. But 100 million, not to say that it's small, but it's incredibly sophisticated in a positive sense, thinking of all the elements that might scare LPs or might make the nature of the financing not useful enough for the beneficiaries and for the founders that you will be investing in or lending this money to. So just to interrupt this small intro, what made you decide to design this fund, this first fund, in such a unique way? What made you think, okay, we're going to put in the efforts, the legal efforts, the coalition, the collective sources of capital to make it work?
Thanks for that. And I think we're trying to learn lessons learned from the past. So past performance with private credit funds serving the SME market may have been lacking, and there's a need to address performance, liquidity, maturity, risk issues generally. So learning from the past and improving, but also directing and channeling that private capital for climate adaptation. We all know that Africa is less than 4% of global emission, but we are suffering 50 to 80% of the damage. And actually, it's happening faster on the continent. It's warming up 2 to 3 times faster than the rest of the world. And we already see in some parts of Africa more than 40% rainfall. So scale and speed is happening faster on the continent, and there's a greater need for private sector engagement. 95% of finance in climate adaptation is coming from a public source. So learning from the past, driving private sector mobilization for climate adaptation is the key driver. And also recognizing that Fund 1 is a proof of concept. So yes, indeed, quite small with 100 million, the hard cap is 120. But when we can show the proof points with Fund 1, the ambition is to triple the assets under management across multiple funds. So we do want to get to the $1 billion financing in climate adaptation. That's what we need to see. So we're willing to make the effort to design the platform and really scale that across multiple funds.
Excellent. So back to what makes your fund special. You were about to discuss the single element that makes you stand out around your theory of change, perhaps?
Yeah, so the theory of change for us is the understanding that climate adaptation will be solved through a continuum of capital. So climate tech, VC, SME financing, and infrastructure. And right now we see a sort of like concentration of the allocation in infrastructure primarily and climate tech VC. So we really want to draw the attention to flexible growth capital for SMEs. SMEs are really at the forefront of adaptation. Every single business on the continent is going to have to asset-proof their operations against climate risk, access to electricity, water, and procurement. If you're a food producer, your input depends on the farmer. So the SMEs really are also at the forefront of delivering climate adaptation solutions. And what we're really exciting about is future resilience. So sustainable production and consumption, avoiding repeating the mistakes others have made, supply chain security risk, and import substitution as well. So really looking at that, building that future resilience, transforming industries as the continent shows very strong growth.
What made you special also in your presentation at Funds for Change is the fact that you already managed or succeeded in mobilizing African capital for Africa and not obviously tending to, let's say, some sort of criticism, but it's, let's say, other continents' money flowing into the continent, extracting value out of the continent, and treating, let's say, in a north-south perspective, this type of climate adaptation investments as another way to extract value out of the continent. So I was positively surprised of you are managing so much mobilization from the continent already. Would you like to tell us a bit more about this?
Sure. We're also committed indeed to mobilizing African capital for African development. And at first close, we achieved 80% private capital and 50% African capital. And this demonstrates the growing role of local institutional capital in driving sustainable growth in Africa. And that will continue through the second close. So the second close happening in October this year through a listing on the Nairobi Stock Exchange, with a liquidity facility that I'll talk about next, basically will enable the mobilization of pension fund, insurance companies, and sovereign capital from Africa to actually invest in climate adaptation through a listed and liquid vehicle. That we believe is really the future, is local African capital.
Okay, well, that's very interesting to watch. Now to our next section, Sandrine. What's the biggest objection that you face today from LPs, private capital or not, by the way, and how do you address it?
Sure. So there's a couple of objections, I would say. One is exit, liquidity, and first-time manager risk. So for the liquidity part, how we've addressed that concern is we're very grateful to collaborate with Octobre. Octobre is a French-based company that has mobilized $200 million from the European Commission, backed by Société Générale, and they've created a liquidity and maturity facility. So the biggest objection in private market investing typically is an investor is locked in for 10 years with very little liquidity and or ramp out to exit before the end of the life of the fund. So now with this liquidity facility, we're effectively able to, if investors have a liquidity need, they can exit after year 5 and they will be guaranteed 70 to 90% of the NAV payment within 10 days. And guaranteed by this facility backed by Societe Generale and the European Commission. So that, together with the listing on the Nairobi Stock Exchange, on the private market pocket of the exchange, makes the product effectively liquid and listed. That's obviously of enormous value nowadays to investors that may have liquidity need, especially pension funds, insurance companies. Even though their liabilities are really long-term, their requirements is still for short-term 3 to 5 years liquidity. So we're able to provide that in a way that's not dependent on the fund performance or the distribution of the fund. It's actually guaranteed. So that's a major way to address that concern. The other concern is exit. So generally, the bulk of capital in Africa has been allocated to generalist equity fund managers. So the world's over 2 trillion private credit markets, only 5% is allocated to emerging market and only 0.3% is allocated for Africa.
Not to mention that there aren't that many SMEs who have access to equity financing, and clearly way more to debt. So private debt is one alley, but usually it's just banking, really. And with all the needs that we know in every single continent, but especially in Africa around working capital financing, and the need to have money upfront to invest and to recruit, etc. I'm just making this extra super clear for our listeners because the level of sophistication of this conversation is immediately on liquidity and product structuring, etc. Yes, but you're doing all of this to be able to deploy that type of money into the hands of real companies who have supposedly basic financing needs, but today there's clearly a mismatch between what the financial industry is providing to the SMEs on the ground and what they're actually selling to LPs. So you're one of the ways to respond to this mismatch. So I applaud you for that. So sorry for an interruption, but I think it was important for me to make it 100% super clear for everybody.
Absolutely. There is a dearth of capital on the continent, the scarcity of capital at all levels, equity or debt, I would say. And indeed, the continent is growing, businesses are profitable, banks are not lending. And if they are, it's at extortionate interest rate between 20 to 40%, high collateral, short term, only really financing inventory and receivables. So there's such a scarcity overall of capital for working capital needs and for CapEx and growth investments. So that's really what we're here to provide. And that's why we go in these structuring intricacies in order to really bring this very scarce private sector capital that is much needed for SMEs to grow on the continent. The climate investment opportunity has been estimated at $2.8 trillion on the continent. And we only receive 3% of global climate finance. So yes, there's scarcity all the way that you look at it, whether it's global climate finance, equity or debt. So yeah, bringing that vital capital is essential and strategic for many reasons. And that's why we're really addressing the exit concern, the liquidity concerns of investors. And I think debt has the beauty of its interest and a loan principal repayment. It's 5 years, 5 to 7 years. And it's a self-liquidating instrument. You don't need to wait for an exit that may or may not happen. You know, it will give liquidity to investors from year one with a semi-annual cash interest and the principal being repaid as well. So that really addresses also the other untold concern of investor, which is exits. Will exit happen? So I think the instrument lends itself well for investors and lends itself obviously very well for a market that's starved of capital. The other aspect is first-time manager risk, emerging manager risk. So we're a very experienced team, having managed more than 1.5 billion in assets and delivered over 20 successful exits across Africa as a team and as individuals that have come together. However, by all means, the strategy is a Fund 1 strategy for climate adaptation. A lot of the climate finance may not have 20 years of track records because a lot of these issues are new and we're leading in basically these type of new strategies, and these strategies are very much needed in the market, and therefore we're Fund 1. However, we are putting also in place, besides the structuring, also collaboration. So we're going to partner with a third-party AFM, a very large asset manager that will be announced later in September.
Yay.
To basically
I'm
help
excited
us
already. Yay.
to leverage some of the institutional capabilities. Obviously, we're a small investment team that's going to be very focused on deploying capital. The first investments are coming out in the second half of the year. So we will be supported by a large asset manager for independent NAV calculations, CFO, risk officer, and really to deliver that institutional reporting that investors also want to see from coming out of Africa. So yeah, we've put that in place to also mitigate and address that emerging fund manager risk. And ultimately, investors are backing people as much as they're backing the fund. And our team experience also really helps to bridge that trust gap, I would say, that trust deficit between investors and GPs.
Your fund has a very specific focus on gender equality and the financing of women-led SMEs. Why do you believe that it's a sound investment approach beyond the moral element, beyond the justice element, beyond the higher standards in terms of values element? Why do you believe it's a sound investment approach to focus on women investments?
We've tied 50% of our carried interest as a fund manager to 5 criteria: job creation, climate adaptation, gender equity, intra-Africa regional trade, and private sector mobilization. So we have skin in the game, and we believe that superior returns will be realized when these 5 elements work together. And on the gender equity part, if you look at the climate adaptation sectors, and what happens when a disaster hits. And you can think about the recent experience we all experienced as humanity with COVID. Well, when you have a climate disaster, it is also an emergency. What do you want to continue? The essential sectors. So food, health, resilience, emergency response, and human capital. So these are the essential sectors. We've all learned to love them during COVID, and they're equally relevant for climate adaptation. What is at the heart of those sectors? It's women farmers, nurses, teachers. Who are the consumers in those sectors, typically in Africa? Who pays the groceries, the healthcare bills, and the school fees? Women. We also know that women, not only as consumers and employees, but also women managing businesses, typically repay their loans. The default rate is lower. So women and young people in Africa, you need to understand, really are the heart of the consumer economy. They are the heart of the growth and the GDP growth. So it's very intentional that we also put women in our credit strategies and reflect their role in the success of the investments, in the success of building resilient community and resilient economies. They're at the heart of it by default in the geographies that we're looking at, and the frontier market growth really driven by women in so many ways. So we recognize that, we integrate that in our credit strategy, and we're looking at the product, the services, and the improvement over time, right? So it's the ability to be a fund that's over a 10-year period of time. I think we can really track those trends and those changes that will happen over 10 years, that will also be a proof point for how the improvements we've been able to make have actually materialized and realized both returns and impact at the same time.
I have to ask a last question. You say that women are at the heart of consumer economies. The problem with our current economic systems is that precisely focus on the consumption is part of what makes the world go not round anymore. And coming back to the question of planetary boundaries and overconsumption, there's a very strong tension. So how do you discuss, especially with the LPs that are the most, invested into these topics of contributing to being part of a solution rather than just keep building on the problem? How do you convey the idea that your approach in Africa, in the companies that you invest in through private credit, are the ones that will convey or expand a type of consumption that is not increasing the level of extraction and pressure on planetary boundaries, but on the opposite, so maintaining essential goods and services. How do you navigate this tension?
I think Africa is the playground for climate adaptation investment because already we're less than 4% of global emission. And the industrialization of Africa has been happening in very different ways than the rest of the world. The growth rates, especially right now, are surpassing and being more than what you can see in Asia. However, industrialization in Africa is really different. It's driven by SMEs. It's also being driven, in my view, in ways that are really already including planetary boundaries, being good for the planet and nature solutions. It's embedded because Africans know everything about resilience already. They've had to build without the capital. They've had to build with scarcity in mind, with affordability in mind. They've had to build with a lot of the natural world because it's not been industrialized, and in a way, it's been done together with nature. So we see that really happening in the type of investments that we back, that we're leapfrogging already and learning to avoid repeating the mistakes that have been done in the developed markets, if that makes sense. So, and there's very good reasons to say that was already intrinsic to the way that Africa was developing its industries at a slower pace, yes, but in a much, much better way, in my view. Because if you look at a country like Kenya, we already are over 90% renewable energy as a country through geothermal energy, right? So we're already starting from a really good basis for the growth that's coming into the different sectors. And I think Africa has all the resources. When you talk about food production, it can really be the garden, not only for, food security of local communities, but also for trade with EU. We have huge dependency on agricultural inputs and trade with Europe. But we can do that from an organic perspective, from regenerative agriculture, because all the resources are here, whether it's food, whether it's energy, with 30% of the world's critical mineral reserves, 60% solar energy, whether it's food or energy, the continent is really rich in that. And it's really on us to make sure that when we talk about production and consumption, it is truly sustainable production and consumption. We're adopting the best practice and the best technologies. And I would love to see, you talked earlier about the capital. It's capital, it's know-how, it's who joins us in weaving those conversations to make sure the outcomes are delivered. And we love to see technology transfer either from Africa to Europe or from Europe to Africa. When we see deep tech in food security and health, we want these solutions also on the continent because we really can leapfrog. And also the continent is also creating some of these solutions as well. I'll give you a brief example to illustrate that it goes beyond, and those links are already happening today. Salmon production, which of course we like to eat in Europe, but the waters in Canada, Ireland, Europe, and New Zealand are becoming too warm for salmon production. So that has led to increased use of antibiotics. And when you look at the skin of the salmon, and it has a lot of wounds that are not healing. So salmon producers are relocating their production in Africa, Namibia, and South Africa because the waters are cold. And that requires much less antibiotics and much better quality product and less pollution. Climate is already driving, whether we like it or not, relocation of food production to other places. And we've got to make sure that we produce sustainable aquaculture, sustainable dairy, transition to plant-based proteins, and that we do things differently, and that we really have to change how we produce and consume so that we respect nature and we put the human back in the equation where it needs to sit in harmony with nature. I think we've used our human intelligence against the greater intelligence, and that needs to be reversed. So it's not a question of nature only, but it's putting the human back within nature and doing better, because I think nature has already provided everything we need for sustainable living. We need to use that and use it differently. And these are the things I see every day on the continent. and they're doing it already. It's not something that needs to be changed. It really is something that's ingrained in the way that businesses here operate.
Thank you, Sandrine. The reality is that I would have so many more questions to ask, but that will be perhaps for another time when you have more things to announce. Moving on to our flash round. So the game here, it's big questions and short answers. Okay? Ready? Yes. First question. What stayed with you after Change Now?
Positive vibes, motivation, optimism, relationships, and conversations that are still continuing today.
Second question. At the heart of Change Now, there is collaboration between players. So what would it take to have GPs collaborate more in your space?
Recognizing many of the challenges we're trying to solve are bigger than any one fund or any one institution. And so more intentional knowledge sharing, co-investment opportunities, and aligning around common impact goal and language. Climate adaptation is a new field. We're building this together. We're learning together. We need to have the humility to recognize that we are building as we are investing and doing. So creating that common language for genuine impact measurement and climate adaptation. This is even a GPLP conversation. We're grateful that we're starting to see insurance companies in the kitchen with us to design those frameworks because, they've realized, of course, it's at least 25% cheaper to invest in climate adaptation than to pay the claims after the damages. And we can also see development finance institutions really playing an active role. BII developed the climate playbook. UNEP-FI also is doing a lot of work in impact measurement toolkits and taxonomy. There is a green taxonomy in Europe. There's one in Africa. There's over 50 taxonomies, and really developing the toolkit that enables us to say this is a real climate adaptation investment and why. So I think that's what we're really interested in, sharing lessons learned and collectively mobilizing capital into these underserved sectors and geographies, and doing this together as an ecosystem.
Well, thank you, Sandrine. I hope our listeners will take some more interest into taking a closer look at what is happening in Africa, which is not a single coherent nation or bioregion. And there are so many nuances to obviously what we've been able to share in such a short period of time. But thank you for coming on Alaka, and thank you for making it happen also at Funds for Change. And we're very happy to have you there. And we wish you all the best for the next stages of your development at your fund. Thank you,
Thank you. Thank you for inviting me here to Alaka and continuing this conversation.
Thank you for listening to Alaka. If this conversation sparked something for you, share it, leave a review, and subscribe for more dialogues at the intersection of capital, systems, and transformation.